We are back for another video. Today we are looking at CVS, pharmacies, and things like that. CVS has been declining for a while now. Oh God, don't mind the hair. Have not showered yet today, but CVS has been declining for a while. The stock is not looking great. Honestly, their long-term growth rate is negative as far as I know. But overall, just kind of shaky with the entire company in general. So we are going to look through their financials, check out their recent earnings, and then go through the chart. So if you are interested in learning more, stay tuned. Make sure to subscribe if you haven't. Comment any companies you want me to review. And let's get into CVS. All right, so here is CVS. So obviously, healthcare services, pharmacy, wellness, things like that. But there are some industry metrics here. So, for example, same store sales percentage. I'm assuming this is only increases, but you can see they're actually doing okay with increasing same store sales percentage, which is good. Although it looks like their number of stores are going down, at least compared to the 2 quarters they have here. Total medical membership is actually going up, which is good. I'm sure that will definitely help with their revenue. Medical cost ratio looks like that is also sort of trending upwards. I'm honestly not sure exactly what that means. Operating expenses, apparently they're going to have an enormous amount of operating expenses just in the next quarter here. I think that may also be an estimate though. I'm not sure. And then don't know what that is. So anyway, let's just get right through the financials. If you want to skip the financials part and just get right into their earnings report and their chart, you can skip ahead to like 5 or 6 minutes into the video. Just I understand some people don't enjoy the financials part as much, but again, if you do want to just skip 5 minutes ahead, you could look through the earnings report that I'll be going over. But until then, let's get into it. So cost of capital is very low for them at 5.5%, which is pretty solid. Target price at 66, slightly above the 58 they're at now. And then long-term growth rate is at negative 1.8, which is not fantastic. Generally, we only want to see positives, and even like lower positive numbers aren't great either. So being just negative no matter what is pretty bad. But anyway, we can actually see here. So this is in their past few quarters. We're going to go out to years here and show how their overall sales growth is. So you can actually see their sales have looked very, very decent. A fair amount of growth for them and very consistent as well. So I'm honestly not entirely sure where all of the, well, there could be a problem there. 300, I'm assuming this is million. This has to be millions. That may be in billions. Holy crap. So they don't make any money is what I'm seeing here. Okay, they make 5 billion in net income, which I guess is fine, but they make 369 billion in revenue. So their sales are honestly crazy. I don't even know what to say about that now. Their operating revenue, though, took a pretty big hit. And also their operating revenue is so low compared to where their sales are. I mean, that's just their cost of goods sold is enormous. Now, one thing to remember, sort of mainly a retailer focused around pharmacies. So a lot of their prices, they actually can't even control. But for the most part, they probably just with retail, their margins are low. But oh my God, I had no idea they made so much money with CVS Health Corporation. Net income, again, very, very low. I'm doing 0.5s for these only because I honestly wasn't even expecting their numbers here, but you can actually see their net income is very low compared to where it could and should be. So I'm actually going to do the big zero there. And then also operating, you could see it's at 11 now, or estimated to be at 11, and it has been right around that area for a long time now. So they really just don't make any more money, even compared to 2014 operating income at 8 billion. Their sales are a fraction of what they are now. They're a third of what they are now, and yet operating income is only 3 billion higher. That is very bad. Also, net income at 5 compared to net income being at 4.6. That's insane. That's really, really bad. They are very much struggling to make money here. So I'm going to do a 0 with the operating income as well. Obviously, same story is going to go with EPS. And let's see what their shares are looking like. So we are seeing decreases in shares, which is something positive there. So let's check out the balance sheet. Possibly some good things here. Possibly. So I'm assuming this is also all in billions. So overall with cash, we have about 11 compared to not too much short term. Now, to be fair, this is, again, billions of dollars in short term debt, which is a lot of money, but overall not too bad. So cash and short term looks good. Their assets are fairly steadily increasing. You could see a bit of a stutter there in 2022, but other than that, they're increasing. And then overall debt, it looks like they are basically just even with it. So I'm just going to do the 0.5 there because their debt isn't that crazy considering how much cash they have. And then retained earnings, I'm assuming will be very positive, which they are. They have a ton of retained earnings, which is always a good sign. So anyway, let's get into the cash flows here. Should be seeing hopefully something better. Looks okay. So operating cash flow, all of it entirely funds from operations, which is good. That is basically the only place operating cash flow can come from for the most part, but still good. CapEx looks like they are purchasing a lot of investments, which is good. Acquisitions, good. A little bit of capital expenditures, which is fine. But overall, having acquisitions and investments being purchased is always a positive. Financing cash flow looks okay. You can see they've been issuing a lot of debt over the past 2 years, which is not great. But overall, I mean, they're repurchasing their stock. Looks like it's mixed. Excuse me. It looks like it's mixed for financing activities. And then for free cash flow in general, they are very positive. However, they are expecting to take a massive hit to their free cash flow in 2024 for the whole year, which is not great for the company. So going to go with the 0.5 there. Let's get into the uses of cash. So we want to see the debt repayment, which we know they have been issuing debt, and we can see that kind of here. Some issuances here as well. Overall, they're also repaying a fairly decent amount. So that is another thing to think about. It looks fairly mixed other than in 2023. We can go into the quarters here and see what it's looking like for 2024. So you can see this kind of changes the story a bit. They have issued, looks like over 8 billion in 2024, just about, with another 6 billion in 2023 or more, actually, most likely more, which yes, they have. So they have been paying off a lot as well, as you can see with the numbers here, and also a ton in interest expense. But overall, they have been issuing more than repaying their debt. However, again, they have been actually recently, they have been repurchasing stock. They did a big one in the beginning of 2024. It looks like it's more of a yearly thing where each year they do one in the beginning of the year. So overall, though, the consistency there is good. We saw earlier on the balance sheet, their total shares consistently going down, or sorry, the income statement, total shares consistently going down. So that is pretty good. So let's get into the ratios here. Should see some okay things, I'd imagine. SG&A to sales is very low. Now, one thing with this is it's so low, but their net margin is so small. So that's something to think about. They just spend so much money on cost of goods sold that it just is kind of crazy. But overall, their SG&A is at a little under 11, average is 12.25, which is good to be below that. For net margin, we're looking at basically a match, which is fine considering their sales have been increasing. That is perfectly fine there. ROA and ROE are above average, which is good. We like to see that. And then debt to equity is just under 100. Looks like it used to be above 100, although it also used to be below. But overall, I mean, it is under 100, but it is not decreasing. It actually looks like it's trending up. So I'm going to go with the 0 there. Although I know I do have below 100. It is just barely below and increasing significantly. So I know it is below the 5-year average, but we're looking at the past 3 years at the moment. So it was higher, which is true, but it looks like it's trending back up. But overall, for CVS, I'm actually seeing a fairly better score than I was expecting. So a 70% is not bad at all. That's actually in the upper range of what I have reviewed so far. So a 70 is fairly decent. Now let's get into their earnings report. So I believe they're reporting this week, although I don't think it came out yet. And it looks like, it has possibly 6th of November. So, maybe not. This is from last month. Sorry. But anyway, let's look at the metrics recap here. Hopefully we see some nice, wonderful things. Sorry for the zoom, but all right. So operating margin, big hit to it. Revenue missed. Operating profit beat. Claims looks like they're down, which I'm assuming is bad. Most likely want more of these, but honestly, I'm not 100% sure. Generic dispensing rate is down, which is probably not good. Revenue. So this is for their health services segment. Pharmacy and consumer wellness segment looks like they beat on revenue, beat on operating profit. Significant growth in pharmacy at 19.5%. Front end, I'm assuming, is just like their stores in general, like not including the pharmacy part, which saw a slight decrease, but I mean, the pharmacy growth very clearly canceled that out. Prescription volume increased significantly. Generic dispensing rate, slight decrease, basically a match. And then healthcare benefits, revenue beat, operating income, very significant miss compared to a year ago. I don't know what MBR means, but 95%. And then they have 27 million in their membership. So overall, looks like a fairly decent report, other than the operating margin being so low. That is really bad, to be honest. Hopefully they can improve that in the future. But other than that, we can look at if it'll let me zoom out here. Other than that, we can look at the street takeaways possibly. Now, this is for 1 month before. So I believe this is in reference to their CEO being changed, possibly. So they had a guidance update and then they changed their CEO. So overall, target remains neutral, 59 from 68. So they had their target lowered. Average target didn't decrease though. Looks like this is target maintained at 68. So one decreased, the other stayed the same. Some negatives here, some positives. Not really looking at anything too crazily specific. If you want to read through this, you can. But overall, CVS looks okay in their last report. But again, it's more of just a general thing. Now, one thing I do want to show is just them compared to the S&P, which you could see right here. They have very significantly underperformed recently, and we will get into their chart right here. So I actually have them compared here against the S&P, and you can see the S&P doesn't even register all the way onto the chart just because of how much outperformance they've done. So for example, this is over the past 5 years. CVS has been down 22% over the past 5 years, while the S&P obviously is up like over 100%, I think, in the past 5 years. But overall, let's just get rid of that. We'll look at just their chart. So we can see very steady decline. Just in the past year, they're down as well, dropping all the way from like 68 to now 58. So really not looking fantastic. There is some recent news, new CEO in October. Looks like they're anticipating a free cash flow increase despite decline. In-store clinic visits have stalled, but margins are expected to improve. So possibly some forward-looking prospects there. But overall, CVS, I would say on the company side, it looks slightly worrying with the stock and everything. On the financial side, it looks okay. But overall, I mean, you could just see the stock price speaks for itself, where it is essentially at the same exact price that it was at in 2013 right here. So no growth in 11 years is not great. Definitely something to be concerned with. But overall, that's all I have for CVS. Hope you enjoyed. Hope you learned something. Make sure to subscribe if you haven't, and I will see you next time.